In this lecture, we explore U.S. domestic tax rules requiring income tax withholding on non-business income. In a previous lecture, we examined non-business income that is subject to tax. The withholding rules and regulations are voluminous and detailed. No purpose is served from attempting to become an expert in these rules, so we will not try to do so. However, working knowledge of withholding is necessary to avoid some of the more costly errors in this area. Accordingly, the objectives of this lecture are to understand the following. The primary withholding statutes, the types of income subject to withholding, persons from whom tax must be withheld, persons required to withhold tax, forms and certificates that impact withholding, and income tax withholding rates. Let's talk about how to use this lecture. This lecture includes a PowerPoint audio-video portion and a written portion. The written portion has two parts: the script for this lecture and the authoritative reading assignments. The citations for the authoritative reading assignments are noted in the left column of the written lecture. You can click on each citation to go directly to the assigned reading. The reading assignments themselves are located after the written lecture. An index of all of these reading materials is at the top of the written lecture. One way to interact with this lecture is to listen to the recorded lecture first while following along in the written lecture or the written script. This provides an overview of the material. Then go back to the written lecture and read the cited material in the order presented in the lecture. You can also use the text Fundamentals of International Taxation to read more on a particular topic. The discussion of the material in this lecture is primarily at pages 67-3 to 67-56. For additional or alternative reading on the material presented in this lecture, see the text Fundamentals of International Taxation at pages 6710 to 67150 and 67149 to 67175. We are concerned primarily with two areas of withholding: Chapter 3 withholding and Chapter 4 withholding. Most tax on non-business income that is subject to tax at 30% or a lesser rate, if a treaty applies, is withheld under Chapter 3, and in that chapter we are concerned primarily with sections 1441 and 1442. The 30% tax on non-business income is also withheld under Chapter 4, and in that chapter we are concerned with sections 1471 and 1472. Chapter 4 is often referred to as the FATCA rules. Both Chapters 3 and 4 require withholding on non-business income. However, Chapter 4 takes priority, and if tax is withheld under Chapter 4, it is not withheld under Chapter 3. Section 1441 provides for Chapter 3 withholding on tax payments of non-business income to non-resident aliens. The regulations under Section 1441 provide for withholding on payments of non-wage compensation to non-resident aliens. Such compensation is not ordinarily non-business income, but is instead effectively connected income. However, as an exception to the rules normally applied to effectively connected income, such compensation is ordinarily subject to withholding. Section 1442 provides for Chapter 3 withholding on payments to foreign corporations. Section 1471 provides for Chapter 4 withholding on payments to foreign financial institutions, FFI. Section 1472 provides for Chapter 4 withholding on payments to non-financial foreign entities, NFFE. Other Chapter 3 withholding rules include Sections 1445 and 1446. Section 1445, withholding on dispositions of U.S. real property interests. This withholding provision will be covered in the lecture on U.S. real property interests. Section 1446, withholding on a foreign partner's share of effectively connected income. We will talk briefly about this withholding requirement in a later lecture. Let's discuss the differences between Chapters 3 and 4. Chapter 3 withholding applies to payments to all foreign persons, whereas Chapter 4 withholding applies only to payments to foreign entities. Chapter 4 withholding takes priority over Chapter 3 withholding. The purpose of Chapter 3, which is a much older part of the code than Chapter 4, is to collect tax on non-business income. The primary purpose of Chapter 4, on the other hand, is to prevent U.S. taxpayers from avoiding U.S. tax by placing assets in foreign financial institutions and non-financial foreign entities. As discussed later, if such entities comply with certain U.S. disclosure and other rules, no withholding is required, and the regular rules of Chapter 3 apply. Here's an overview of income subject to withholding. In general, the income subject to withholding that we will be discussing in this lecture is primarily limited to non-business income that is taxable in the United States when received by a foreign person. As in the lecture on the taxation of non-business income, our focus in this lecture will be withholding as it relates to taxable interest, dividends, rents, royalties, and other FATCA income. In general, business income that is effectively connected with the conduct of a U.S. trade or business is not subject to withholding. However, income from non-employee services of a non-resident alien, which is effectively connected income, is ordinarily subject to withholding. This is discussed later. Tax on capital gain is generally not subject to withholding except for capital gain taxed under Section 1445. Let's now talk a bit about the amount of withholding. The general rate for withholding under both Chapters 3 and 4 on non-business income is 30%. However, if a tax treaty applies, the tax rate may be reduced by the treaty. If the tax rate is reduced by the treaty, then the withholding rate is likewise reduced. Later in this lecture, we discuss how to claim a lower rate of withholding under a treaty. There are other statutory tax and withholding rates that apply to specific types of income. See Publication 515 for a discussion of these rates. Withholding is always at the maximum rate unless the withholding agent has documentation upon which it can rely that shows that the beneficial owner is entitled to a reduced rate of withholding. Withholding is ordinarily based on the gross amount of the payment, even if the foreign person can reduce the amount of the income subject to tax with deductions when a U.S. tax return is filed, or if a portion of the receipt is non-taxable, such as where part is a return of capital. Some exceptions apply for this rule. Let us now turn to withholding under Chapter 3. Withholding is generally required only when a taxable payment is made to a payee who is a foreign person. For this purpose, a foreign person is a non-resident alien individual. We covered the classification of individuals as non-resident aliens in an earlier lecture. A taxable foreign entity. These are foreign corporations, trusts, and estates. We covered the classification of entities as foreign in an earlier lecture. A foreign partner, that is a non-resident alien or a foreign taxable entity. Certain foreign branches of U.S. companies. Governments of foreign countries. Note that corporations organized in certain U.S. possessions are not foreign corporations. If tax has been withheld from a foreign person's U.S. source income, does the foreign person still have to file a U.S. tax return? In general, a foreign person ordinarily does not need to file a U.S. income tax return if the person's tax liability is fully satisfied by withholding. However, the person does need to file a return if the person was engaged in a U.S. trade or business. In addition, the person needs to file if the person had only non-business income and not all of the U.S. tax owed on net income was withheld. Here's an example of the general requirement to withhold. Domestic Co. is a U.S. corporation that borrows money from Foreign Corp., a country X corporation. Foreign Corp loans $1 million to Domestic Co., which Domestic Co. repays with $50,000 of interest a year later. The interest is non-business income to Foreign Corp., taxed at 30% and also subject to withholding. Domestic Co. withholds the tax and remits the tax to the U.S. Treasury. It reports both the interest income and withholding on Form 1042 and Form 1042-S. These forms are discussed later in this lecture. Foreign Corp's U.S. tax liability has been fully satisfied with this withholding, and that corporation need not file a U.S. tax return. U.S. source income paid to a non-resident alien with respect to independent personal services performed in the United States, that is, non-employee services, is not taxed as non-business income, but is taxed as effectively connected income. However, under special rules, income tax withholding is ordinarily required. Income paid to a non-resident alien with respect to personal services performed in the United States is ordinarily classified as business income under Section 871B, see the lecture 2-1, and is not non-business income taxed under Section 871A. Nevertheless, such income may be subject to the same 30% withholding as non-business income. Where such compensation is for services performed as an employee, then the income is ordinarily subject to U.S. wage withholding under Section 3402 and is not subject to Chapter 3 withholding under Section 1441. Note that this exclusion from Chapter 3 withholding applies as long as the wages would be subject to withholding if not for being exempt under Section 3401A, such as where wages paid to household workers are exempt from withholding. When a non-resident alien earns compensation from non-employee services performed in the United States, this compensation may be subject to withholding. Such compensation may be classified as payments to independent contractors, non-employee athletes and artists, non-employee professionals such as doctors, accountants, and attorneys. Such income is often termed independent personal services income. When a non-resident alien has independent personal services income that is taxed in the United States, such income is ordinarily not exempt from withholding under Section 1441 because it is not wage withholding. Therefore, the income is usually subject to withholding at 30% unless a tax treaty applies to reduce or eliminate the withholding. Withholding is required on the gross payment of compensation, even though when the non-resident alien files a U.S. tax return, the non-resident alien can claim business deductions against this income. Here's an example of withholding on a non-resident alien's compensation. Fabio is a Country X consultant working as a sole proprietor who travels to the United States to perform consulting services for USCO, a U.S. corporation located in New Jersey. He performs all such services in New Jersey. Fabio is a non-resident alien and an independent contractor. He has paid $15,000 for his work for USCO. He pays all of his own expenses, travel, transportation, meals, tools, and equipment, which total $5,000. No treaty applies, and his work constitutes a U.S. trade or business. He will file Form 1040-NR and report net taxable income of $10,000. However, USCO should withhold tax on the gross payment at 30%. Adopted in 2010, the Foreign Account Tax Compliance Act, or FATCA, added a new layer of withholding rules under Chapter 4. Chapter 4 provides for withholding taxes to enforce new reporting requirements on specified foreign accounts owned by specified U.S. persons or by U.S.-owned foreign entities. The provisions establish rules for withholding on payments to foreign financial institutions, FFIs, and for withholding payments to non-financial foreign entities, NFFEs. Section 1471 requires 30% withholding from payments to an FFI on non-business income if the FFI does not meet the requirements of this section. To meet the requirements, the institution must enter into an agreement with the IRS to obtain information about each account maintained by the FFI as is necessary to identify accounts that are U.S. accounts, to report account information annually, to withhold 30% tax on pass-through payments to recalcitrant account holders, and to perform other activities described in this section. Chapter 4 also requires withholding on payments to an NFFE. Section 1472 requires 30% withholding from payments to an NFFE on non-business income if the NFFE does not meet the requirements of this section. To meet the requirements, the NFFE, with respect to each beneficial owner of a payment, must certify to withholding agent that such beneficial owner does not have any substantial U.S. owners, or provide the withholding agent with the identifying information of each substantial owner of such beneficial owner. In general, a tax treaty between the United States and a foreign country may reduce the amount of income subject to tax and withholding. The rate of withholding on a payment of income subject to withholding may be reduced to the extent provided under an income tax treaty in effect between the U.S. and a foreign country. However, the treaty benefits apply only to the beneficial owner of the income who is a resident of the treaty country. The withholding agent is generally the person, including an individual, entity, institution, government, etc., with the responsibility to withhold tax from the payee under Chapters 3 or 4. A person is a withholding agent if it is a U.S. or foreign person, in whatever capacity acting, that has control, receipt, custody, disposal, or payment of an amount subject to Chapter 3 withholding or a withholdable payment under Chapter 4. In most cases, the person who pays an amount subject to Chapter 3 or 4 withholding is the person responsible for withholding. Here's an example of a withholding agent. USB is a U.S. corporation and securities broker doing business in the United States. USB pays U.S. source dividends to Foreign Corp, a Country X corporation that has a brokerage account with USB. No tax treaty applies, and the dividends are subject to withholding at a rate of 30%. USB is probably a withholding agent because it is the person that has control over the payment to Foreign Corp. A withholding agent is generally required to withhold tax under Chapter 3 or 4 on payments subject to withholding made to foreign persons. A withholding agent must withhold on any payment subject to withholding made to a payee that is a foreign person. The withholding agent is generally responsible for determining the amount to be withheld. The withholding agent is generally personally liable for any tax required to be withheld. However, if the withholding agent fails to withhold tax and the foreign payee fails to satisfy its U.S. tax liability, then both the withholding agent and the foreign person are liable for the tax as well as any interest and applicable penalties. Withholding is generally required on payments to foreign payees. Chapter 3 withholding applies only to payments made to a payee that is a foreign person. It does not apply to payments made to U.S. persons. Chapter 4 withholding applies to withholdable payments made to an entity that is an FFI or NFFE, unless these entities meet requirements to be exempt from withholding. In most cases, the payee is the person to whom the payment is made, regardless of whether the person is the beneficial owner of the income. However, there are situations in which the payee is a person other than the one to whom the payment is made. There's an exception to the general rule for a payment to a U.S. agent of a foreign person. For purposes of Chapters 3 and 4, if a payment is made to a U.S. person and the withholding agent knows that the U.S. person is receiving the payment as an agent of a foreign person, the withholding agent must treat the payment as made to the foreign person. There's also an exception for payments to U.S. financial institutions. If the U.S. person to whom the payment is made is a financial institution, the withholding agent may treat the institution as the payee, provided it has no reason to believe that the institution will not comply with its own obligation to withhold under Chapter 3. Similarly for Chapter 4, except payments to U.S. insurance brokers are also included in the rule. Withholding can be presumed to be required if payment is made to a foreign payee, unless the documentation shows that the beneficial owner is a U.S. person. In many cases, the payee is not the beneficial owner of the amount being paid, and it is necessary to determine the beneficial owner in order to know whether to withhold and at what rate. The beneficial owner is ordinarily the person who is the owner of the income for tax purposes and who beneficially owns that income. A person is treated as the owner of the income if that person must report the income as gross income on its tax return under U.S. law. A payee is not a beneficial owner to the extent that the person is receiving a payment as a nominee, agent, or custodian, or to the extent the person is a conduit whose participation in the transaction is disregarded. Likewise, foreign partnerships, foreign simple trusts, and foreign grantor trusts are not beneficial owners since all income is merely passed through. Here's an example of withholding based on a beneficial owner who is different from the purported payee. Domestico makes a dividend payment to Lipton, a country ex-citizen and resident. Unless Lipton can provide documentation to Domestico proving that the beneficial owner of the payment is a U.S. person or is a foreign person entitled to a lower rate of withholding, then Domestico must withhold at 30%. Assume that Lipton is the nominee for Adams, a UK citizen and resident who is a beneficial owner of the payment. Adams prepares Form W8BEN, indicating that she is a beneficial owner of the payment. Adams uses the form to indicate that she is entitled to the benefits of the US-UK tax treaty, and that dividends are taxed only at 15%. Lipton provides Domestico with a W8IMY form, indicating that Lipton is the nominee and includes with that form Adams' Form W8BEN. Based on this documentation, Domestico withholds tax at 15% on the payment and reports the withholding to the IRS as being made on behalf of Adams. If a payment is made to a qualified intermediary, QI, then the payer is generally relieved of the responsibility to withhold tax. When a payer makes a payment to a qualified intermediary, which has assumed primary responsibility for withholding tax, then the payer does not withhold tax. That is, the withholding agent does not withhold tax. For this purpose, a qualified intermediary is a party that has entered into an agreement with the IRS to assume full or partial responsibility for withholding, depositing, and reporting on payments to foreign persons. A qualified intermediary can include a foreign financial institution or a clearing organization, a foreign branch of a U.S. financial institution, or any other person that is acceptable to the IRS. The qualified intermediary may either be a U.S. or foreign person. The qualified intermediary will furnish a qualified intermediary withholding certificate to the person otherwise required to withhold tax. Form W8IMY is often used for this purpose. Here's an example of a payment to a qualified intermediary. Foreign Corp is a country X financial institution that has entered into a qualified intermediary withholding agreement with the IRS. Under the agreement, Foreign Corp is subject to the withholding and reporting provisions applicable to withholding agents and payers, except to the extent provided under the agreement. Under the agreement, Foreign Corp assumes full withholding and reporting requirements. A U.S. withholding agent makes a payment to Foreign Corp on behalf of various persons who have accounts with Foreign Corp. Foreign Corp presents the withholding agent with a qualified intermediary certificate on Form W8IMY, and the withholding agent is relieved of the responsibility for withholding. Foreign Corp will withhold and deposit the tax and will file the necessary reports with the IRS. Foreign Corp need not provide to the withholding agent information about the beneficiaries of the payment. If a payment is made to a non-qualified intermediary, NQI, then the withholding agent is not relieved of the responsibility to withhold tax. A non-qualified intermediary is an intermediary that receives payments on behalf of beneficial owners, but has not entered into an agreement with the IRS to assume primary withholding responsibilities. A payment to a non-qualified intermediary does not relieve the payer of its withholding responsibilities. That is, the withholding agent must withhold tax on a payment to an NQI. The non-qualified intermediary provides the payer with information regarding the beneficial owners of the payments, and the payer, as withholding agent, withholds and reports accordingly. Here's an example of a payment to a non-qualified intermediary. Domestico, a withholding agent, makes a payment of U.S. source interest to a non-qualified intermediary. The beneficial owners of the payment are non-resident aliens who are citizens and residents of country X. The non-qualified intermediary provides a valid intermediary withholding certificate, Form 8, W8IMY, to Domestico, and attached to the form are Forms W8BEN for each of the beneficiaries. Domestico withholds tax based on the information provided in the W8 forms, just as if the payments were made directly to those beneficial owners. Payments to flow-through entities are generally treated as paid to their owners. The payees of payments made to a foreign flow-through entity are the owners or beneficiaries of the flow-through entity. The following are flow-through entities: a foreign partnership other than a withholding foreign partnership, and a foreign simple or foreign grantor trust other than a withholding foreign trust. Note that income that is effectively connected with the conduct of a U.S. trade or business of a flow-through entity is treated as paid to the entity. Special withholding rules apply for fiscally transparent entities, such as partnerships and simple trusts. An entity is considered to be fiscally transparent to the extent that the laws of a jurisdiction require the interest holder in the entity to separately take into account on a current basis the interest holder's share of income, whether or not distributed to the interest holder, and the character and source of the income to the interest holder are determined as if the income was realized directly from the source that paid it to the entity. For withholding purposes, the payees of a payment made to a fiscally transparent entity are the interest holders of the entity if the interest holders are claiming treaty benefits with respect to the payment. The most common examples of fiscally transparent entities are partnerships and simple trusts, where partners and beneficiaries report all of the income recognized at the entity level on their personal tax return, regardless of whether the income is distributed. Here's an example of a fiscally transparent entity. Foreign trust is a country X trust. Under the trust instrument, all income earned by the trust is required to be distributed to its beneficiaries, and under the laws of country X, the beneficiaries must recognize the income as it is earned by the trust, regardless of when it is actually distributed. Foreign trust is considered fiscally transparent. Here's an example of an entity that's not fiscally transparent. Foreign trust is a country X trust. Under the trust instrument, the trustee of the trust has the discretion to pay out income to its beneficiaries or withhold and accumulate that income, and under the laws of country X, the beneficiaries are not taxed on the income of the trust until distributions are made. Foreign trust is not considered fiscally transparent. The manner of withholding changes with certain types of payees and certain types of income. However, a withholding agent may not always have the documentation necessary to know the type of payee or the type of income, and so therefore may not have enough information to know how to withhold. In the absence of complete documentation, a withholding agent must make certain presumptions regarding payees and income. The regulations provide detailed guidance regarding these presumptions. If the withholding agent complies with the presumption rules, it is not liable for tax, interest, and penalties if the rate of withholding that should have been applied based on the payee's actual status is different from that presumed. Presumptions provided in the regulations relate to payee status, partners and partnerships, estates, trusts, and their beneficial owners, foreign tax-exempt organizations. Key presumptions relating to payee status include the following: status as a U.S. or foreign person, the payee as beneficial owner or intermediary, the payee as an individual, corporation, partnership, or trust. However, sometimes a presumption cannot be used to effect withholding. A presumption of foreign person status cannot be used to reduce tax on the portfolio interest exception. Actual documentation is needed. Likewise, actual documentation is needed to reduce tax under a tax treaty. Here are some special rules relating to withholding that commonly come up. Effectively connected income is not subject to withholding, with the exception of payments for non-employee services of non-resident aliens. However, the payor cannot presume income as ECI. It must receive from the payee a Form W-8 ECI in order to avoid withholding. Withholding on interest income is based on the gross amount paid, even if a portion of the payment is return of capital. Withholding on dividend income is based on the gross amount paid, but elections can be made to reduce the withholding for the excess of distributions over earnings and profits, distributions to redeem stock, capital gain distributions, non-taxable distributions of stock rights, distributions subject to withholding under Section 1445. The following are a few of the important forms and documentation used in connection with withholding. The first is Form W-8-BEN and W-8-BENE. Form W-8-BEN is used by a foreign individual to establish foreign status, claim that such individual is a beneficial owner of the income for which the form is being furnished, or claim status as a partner in a partnership subject to withholding under Section 1446A, or a transferee of an interest in a partnership under Section 1446F, claim reduced rate of or exemption from withholding under an income tax treaty, and Form W-8-BENE is used for similar purposes for a foreign entity. Next is Form W-8-ECI. This form is used by a foreign person to establish foreign status, claim that such person is the beneficial owner of the income for which the form is being furnished, claim that the income is effectively connected with the conduct of a U.S. trade or business. Next is Form W-8-IMY. Form W-8-IMY is used by foreign intermediaries and flow-through entities, as well as certain U.S. branches, to establish an entity's status as a qualified intermediary or non-qualified intermediary, and establish an entity's status for purposes of Chapter 4. Forms 1042 and 1042S are used to report withholding. A withholding agent must file Forms 1042 and 1042S for amounts subject to Chapter 3 withholding and Chapter 4 reportable amounts, unless exceptions apply. Form 8233 can be filed to claim treaty benefits in connection with services. Form 8233 is used by a non-resident alien individual to claim a tax treaty exemption from withholding on some or all compensation paid for the following: independent personal services, which are non-employee services; dependent personal services, which are employee wages; personal services income and non-compensatory scholarship or fellowship income from the same withholding agent.